This is exactly why they say the IPO process isn't necessarily about being the most technical or hard thing to do, but it's just a heavy lift on you and the team because there's just so much going on. That's why you have to have the right teams of people around you. Is that fair to say? You know what? We are going to talk a little bit about private company is going public. And you know what they're worried about? They're worried about the accounting issues that are going to get a lot of eyeballs, right? They're going to be like, how'd you assess risk? What are the regulators going to look at? That's what everybody wants to know. So let's talk about that a little bit. What are the accounting issues that are going to get the most looks?
Yeah, and I can start with that, Dean. You know, the biggest, what I'll call issue is the uplift of the financial statements. And they call it the PCAOB uplift, right? Conversion of your private company financial statements to public company financial statements. So you have two things there, right? You have the policies and that go within the financial statements, and then you have the documentation. So the policies, you may have changes to your existing policies, right? So if you were amortizing goodwill, if you were adopting other private company elections associated with how you present your equity, those would all have to change, right? Because you're now a public company. You'd have to adopt quarterly financial statements. So you're going to have to develop a process for producing those every quarter. And then you have new policies like segments, EPS, all things that haven't been done before. Then you have your documentation, okay? From a documentation standpoint, a lot of that's because you're under a PCAOB audit now. You have lower materiality, you have higher scrutiny from your auditor. And in order to address that, you have to produce documentation like you've never seen before. So that means that if you maybe addressed your going concern or impairment with just a couple of paragraphs previously, you're writing full-blown 8-10-page memos to address this because that's what your PCAOB auditors want to see.
Brett, I got to ask you real quick. So you're saying a whole new level of documentation and detail. We can't write the 2-paragraph memo anymore. Basically, you're saying that we've got to cite the standard and why we feel like we can take this position on the standard. Is that fair?
That's absolutely fair. And oftentimes you have to bring in additional experts. Stock compensation is another example, right? So previously you didn't have a memo addressing it. You just booked whatever came out of a system. Now you need a memo documenting how you determine presentation. You need to have an expert coming in. You can't do an internal Black-Scholes model. You need to engage a valuation specialist to update your valuations for that. So there's a whole extensive list of issues and different accounting matters that require documentation and the involvement of different levels of specialists.
Okay. All right. What else? What else do you think needs just a greater scrutiny? Give everybody all the details right now, Wendy. I see the look on your face.
Yes.
Come on.
So there are often trends and comment letters from the SEC, right?
Okay. That sounds scary, Wendy.
Yeah. Well, they're public. These comment letters are public, right? So kind of the top of the list this past year has been non-GAAP measures. So
non-GAAP measures.
Right.
Okay.
So GAAP is king always. So you have to provide a reconciliation between the non-GAAP and the GAAP measures and really help the investor understand kind of what's going on.
What's an example of a non-GAAP measure?
So factoring out certain expenses, right? So there's often one-time expenses that you incur during an IPO process. Could be related to your advisors and things like that. So kind of factoring those out to kind of show what it would look like on an ongoing basis. Also, management disclosure and analysis, MD&A, that's also under a lot of scrutiny because the company can add a lot more detail. And so you have to be able to bridge the gap between what you present in the financial statements and the MD&A, as well as segments, business combinations, pro formas, all of that fun stuff.
I got to ask, both of you have said the word segments. What are segments?
So that's the breakout of your financial statements and from a management lens perspective. So what investors want to be able to see is how does the CEO, how do the people in the company making operating decisions, how do they view the company? And so it's breaking it out typically beyond just the consolidated measure, which we're all comfortable and usually pretty typical seeing within your private company financial statements, to something broken out into different segments. So different products, different geographic locations, things like that. And now there's, it's not necessarily breaking news because it's been in the works for a couple couple of years, but additional segment disclosures that just passed the SEC relatively recently. I think it was the end of last year.
That's right.
Which not only requires breakout of revenues, but now also your segment expenses.
Yeah, that's kind of one of those things that I heard about was, as folks are doing the road show and kind of showing numbers and talking about pro forma financials and what might happen, is putting together numbers that you think your organization can hit. I think that's really important these days when we know unit economics and having numbers that you can get to. That's really what's going to increase your enterprise value over time. Is that fair?
Absolutely. I mean, like part of the process is like developing your key performance indicators, right?
Yeah,
like
KPIs.
how can, you judge your growth or measure your growth in the future? So it's an integral part of this.
Yeah, I heard our CFO say, don't share a number that people on outside might think is a KPI, and it's not really a KPI, because if that number changes and they're going to ask you about it, you're going to be like, well, we don't manage that.
Exactly.
Guess what? You manage it now. It'll get looked at now. So.
Also understanding your filing status, right? Because everybody's familiar with large accelerated filers and non-accelerated, right? But companies at the outset need to determine if they're an emerging growth company or a smaller reporting company, because that could result in fewer financial statements that need to be included in the filing, as well as some reduced disclosures as well.
Okay, well then people might be biased to be a smaller company, right? So what? No.
There are rules.
No.
There are rules.
Okay,
yeah.
Well, then why don't you break it down?
Yeah, exactly. So a smaller reporting company can have higher than $100 million in revenue. And then there are certain requirements around public float, but don't ask me what public float means. It's a complicated calculation. And then an emerging growth company can't have more than $1.2 billion in total revenues and gross revenues, as well as some restrictions around public float as well.
All right. So basically, the type of company that you're going to file as, there's some regulations around that.
That's right.
That's what people need to know.
Exactly.
Wendy, you scared me earlier when you said comment letters. Talk about timing of all that. Everybody wants to know what's coming around the corner. So with regards to comment letters, let's give them all the information we can.
So within the time that you file your initial filing, 27 to 30 days, the SEC will provide comments. Okay. It could be anywhere from 1 to 70. 70 is a scary, scary number, but it could be very voluminous, right? You have approximately 10 days to respond to that. Now, you need to be organized, prepared, and not really rely on precedents of the SEC's decisions in the past. You can get an extension with your SEC counsel past the 10 days, but after you provide your amendment, they have another 14 days to provide another round of comments. Okay, so there could be several rounds.
So basically, it's going to be quick.
Yes.
Right? That's what you need to know, is that you submit it, the SEC is going to come back with their comments, and then you've got to turn it around pretty quickly, which means at that point, everybody's got to, once you get your comments, you got to hunker down.
You do.
Right?
Yeah.
You and the team got to hunker down, get that done, send it back off.
Absolutely.
Right.
And as you respond, you have to think about future filings too, because you're kind of setting your own precedents within that filing. Yeah.
Brad, you're nodding your head. What else you got?
Well, because of that, you have to be mindful of what's called staleness dates, not to get too much into the details, but the SEC has what they call staleness dates, that anytime, after a certain point in time, those numbers are stale, they don't want to see them anymore, refresh. So when you're doing this comment process, you may have filed, and now you're waiting for comments. Well, those numbers might be going stale. You need to flip around another version of the financial statements for the next quarter, for the annual period, and you have to be mindful of that as you're setting your calendar ahead of time for how the comment letter process is going to work.
Absolutely.
Yeah, I would say consistent with what we've been talking about, documentation is the most significant change from going from a private to a public company. That, and then the cadence. So usually a private company could get away with or just go on, reporting just once a year, the annual financial statements. But when you're a public company, you need to report interim reporting. So 10Qs, which will require interim tax provisions. So you have basically 4 times the amount of reporting from going from a private to a public. And And so that's a lot. You'll have to write memos. Sometimes, companies don't write memos. You'll have to, provide additional paragraphs sometimes, depending on the company's fact pattern. And it's a lot.
When you talk about memos and detail and taking a stand or a different position on the provision itself, give us some insight into that.
Yeah. So first of all, a tax provision is a different animal than a tax return. A large part of the tax provision is estimating what your tax return is going to look like, but then the more complicated piece, in my opinion, is the deferred taxes. So that's where you're reporting your DTAs and DTLs, or your deferred tax assets and deferred tax liabilities, and then applying or not applying a valuation allowance against those. So we're looking at net operating losses. Should they be fully valued? And that goes into areas like Section 382. Are they actually extant? Like, will you actually use those? And it just explodes from there. But you're right. Auditors are going to look at the provision with far more scrutiny, and they're going to ask memos and for memos, a summary memo, but then also memos to support specific positions like FIN 48. It's different from a tax provision perspective because you're telling the investors, okay, this is an uncertain tax position, and that may require a supporting memo or memoranda. It all depends. So it's a lot. It's definitely a lot, and depending on the company's fact pattern, it can be really a lot.
And just additional disclosures for the uncertain tax positions. For private companies, you put basic information in there, but for a public company, you need a roll forward. You need an understanding of what it is as an investor that they are disclosing.
Yeah.
Let's talk about this. What about completeness of something like a state and local use tax or something like that? What about, is that getting looks in an IPO process?
Absolutely. Great question, Dean. Great point. So state and local taxes is interesting because you have parts of it will be part of the income tax provision, but then pieces of it, elements of the state and local tax world, it's what's called above the line, or it's not in the income tax line. It's part of the sales and use taxes. It's sometimes in the operating expenditures. But a tax professional still needs to be very much involved with the above the line tax items, which would include a lot of local taxes. So you absolutely need to understand the company's tax geographic footprint, not only worldwide, but within the states, which we're talking about right now.
Yeah, because I'm just thinking about all the different pieces in tax, right? Transfer pricing, R&D, 382, foreign international, right? Any of those things. So basically, everything that you've done is going to get a look.
Yes. But again, it's really dependent on the company's fact pattern. Sure. Like you could have a company that's just U.S. domestic only. So you forget about international, obviously. Yeah. And maybe they're already profitable. And maybe R&D credit isn't available for whatever reason. Okay. So it just follows. But then like the multi-state analysis is important, and transfer pricing if international. It's endless.
Let's talk about let's kind of go back to the accounting areas that are going to get a lot of deeper looks. We always know the easiest one to start off with is probably RevRec. Right. Is there anything we want to talk about there with regards to RevRec?
I mean, there are additional disclosures that you have to make as a public company versus a private company, because you have certain elections as a private company. So you have to make sure that you're compliant with that. And that's kind of key to make sure that you're disaggregating revenue and providing, an outlook on when you're going to recognize revenue in the future.
Got it.
Yeah.
What about accounting for estimates? I know that anything that has an estimate is going to get big time looks by the auditors and the regulators. Any comments on there?
Yeah, I think that would go to the documentation point, right? It's like if you are doing anything that requires some sort of management estimate subjectivity associated with it. In the past, as a private company, you may just have been able to sit down with your auditor, had a nice conversation like this, knocked it out. Now they want a memo. They have to have a memo putting it down, and they're going to have to send it potentially to their national office. They have to get different specialists involved. So the documentation really goes, the need for it increases quite dramatically.
That said, though, if I may add, it's important to have a good relationship with the auditors. That can save you sometimes a trip to the national tax office, right? If you have a good relationship with your auditors, you can talk about issues that could go up to the national tax office. They might not, because you've just resolved it.
Or working with folks like us that have a good relationship with your auditors, right?
That's right.
Sit on the
course.
same side of the desk as you.
That's
Yes.
right. And some of these are like one-time in nature, right? And they don't want to bring on someone full-time to kind of like, look at these different areas. So bringing in professionals like us is always key.
Right, because you shouldn't be surprised that if you're continuing with the same audit firm as a private company to public company, that once they do the PCAOB audit, they take a step back. Whereas they may have been much more forthcoming about being involved with the setting of policy and giving you their thoughts up front, they may not be doing that anymore, because now they have to create this stronger level of independence. And that's where you have external experts like us come in that can give you that level of expertise without having to mess up any sort of auditor independence.
I just heard about something the other day and it made me laugh because I didn't know what it was. It was like a C something. It was like a C.
Up-C.
Up-C.
Yeah.
Okay, great.
Up-C and tax receivable agreements.
I heard about this the other day and I was like, whoopsie doozy, up-C. What are we talking about here? What is that?
Well, you're talking about when a company goes public, it can be through different structuring. So Up-C, you hear that terminology when you're talking about a SPAC, right? That's the most common situation. Basically, you create a new entity, a brand new company, form-wise, an Up-C. So you're going from, let's say, a partnership up to a C Corp, and that C Corp's going to go public and issue its shares. So that's what an Up-C.
Is there some intricacy there that people have landmines to? They got to make sure that they have to. I see you nodding your heads. Is there some landmines to avoid there?
Because a lot of the times it's put into place, and Nick, you're the specialist, so correct me if I'm wrong, but it's put into place to capture the benefits for the selling owners for their historical net operating losses. So they built a lot of these companies that are going public. They've had historical losses that have built up over time. And the owners are saying, hey, I want the benefit of that. I don't want to go public and now all the benefits accreting to new owners. And so what they'll do is they'll put this Up-C in place and put a tax receivable agreement in place, in which it essentially says, hey, we're going public with this C Corp as Nick described, but to the extent that the public company is getting any benefits in the future from using these net operating losses from historical performance, I want cash back on that. I want it to be distributed directly to me. And until that time, I'm going to probably hold some ownership of that lower level entity until that's paid off. If you're a company that's been built through roll-ups, lots of acquisitions, there's SEC rules about how the significance of these acquisitions are. And depending on how quote unquote significant, and it's defined as every term with the SEC tends to be, depending on how significant, it may require you to also include standalone financial statements of that acquired business in your registration statement as well. So for example, I was going through helping a company with an IPO. They had just bought a couple of companies in the year before, and one of them was deemed significant. So we had the PCAOB audit team had to audit not only the filer, but also these other companies. So you might have multiple sets of financial statements, multiple different companies that no longer produce separate standalone financial statements within your S1 or S4 statement as well.
A lot of organizations over the last couple of years had to take on debt or warrants or areas like that to kind of, get to this next IPO window. Is that an area that gets focused?
That's huge.
Oh yeah, it can be a messy, complex analysis. But I mean, so when you're talking about converting from private to public, they were still there as a private company, right? So technically, you should have been doing these analyses all along. But our private companies doing it, their auditors may not worry so much about that because the only people that are reading the financial statements are lenders, right? And banks don't really care about some of that stuff. But when you got PCAOB audits going on or the SEC looking at it, then absolutely you're going to need documentation that are quite complex. There's a lot of hoops to jump through to get to the final answer for how they're presented, how they're measured, that require the documentation, but then also the complex valuations that would go with those warrants, go with bifurcating potentially embedded derivatives out of the host instrument. So a lot of stuff that has to go on with that.
Get started early, right? Getting in front of all of this. Like, if you know that this is something that you even want to consider, get ahead of this. Is there any stories you want to share or any benefits that you have about getting to look at books as soon as possible and kind of understanding the layout?
I mean, ideally 12 to 16 months before you plan to go public is the best. But a lot of these processes need to be in place at least 2 quarters before you flip a switch and become public, right? Because like what Nick noted, I mean, there's a lot going on, many, many work streams. So the sooner you can get ahead of it, the better.
When it comes to tax, Nick, what should people be thinking?
They should be getting into the habit of reporting like a public company before they're a public company. So that's practice, discipline, lead time.
This is exactly why they say the IPO process isn't necessarily about being the most technical or hard thing to do, but it's just a heavy lift on you and the team because there's just so much going on. That's why you have to have the right teams of people around you. Is that fair to say?
Yeah, absolutely. I mean, nothing in and of itself is too complicated. Of course there are, but it's not really about that. It's about the volume. It's about the cadence. It's about just the challenge.
Yeah, absolutely. I mean, the responsiveness, there's so many different stakeholders within the company that you have to rely upon to get the information that you need.
If you could tell the CFO, a board, an audit committee, folks that are looking to take their company public today from a high level, what would you tell them about just making this a successful process and not just burning your team out?
It's planning ahead. I mean, that seems to be the recurring theme of what we've talked about, but having a detailed plan in place when you start and understanding how long that's going to take.
And it's okay to ask for help, right?
Yeah, I love that.
Yeah.
That's right. Because I just don't think that there's enough hours, right? Like, you still have to operate the company. You still got to report on what's going on. You still got to operate the business and then go through this big uplift. And I think that's the big challenge of the day.
Yeah, and it's all historical too, right? So you're as you're running the company, like in the present and future, you've got all this reporting, which is historical, that you need to be doing too. So it's like,
that's right.
That might not be
Living
fresh.
in 2 time periods,
Yeah.
right?
Living
Exactly.
in 2 time periods. That's good.